All right. Today's Monday, the 30th of June. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy end of the month. Now, before we begin, we have a new programming schedule for you. If you recall, I've been talking about this for a while, the splitflation. We're going to split the videos into a market segment and a macro segment, aka the in focus segment. So everybody's going to get 2 videos a day. And for the public channel, we're going to do one on Monday, one on Tuesday. Sometimes we're going to do the market segment on Monday. Sometimes we'll do it on Tuesday instead. So you're going to get a video either way, Monday and Tuesday. The Wednesday, Thursday, all members, both in focus and the market. Then comes the weekend and we got bonus videos for the members. And this is a win-win for everybody. Everybody gets more videos, more content, and you get it earlier. On top of that, we get the time finally to produce some of these bonus videos that we talked about before, such as the Options 101 series, such as the Maverick Portfolio series, the Stock Battle series, and many more. I'm just trying to build the financial Netflix here, folks, so you know what to do. Gotta join us as a member. Links in the description. If you're broke, talk to your mom. She'll understand. She'll give you some money. But without further ado, let's begin the program with the headlines of the day. We begin with the first headline from Canada. What are you having for dinner tonight? Because we already had Canadian tacos today. Usually we get orange tacos, but today we got Canadian tacos. As Canada now rescinds the digital service tax, of course, because Trump made a big deal out of it on Friday, threatening he's going to send the B-2 bombers to Toronto. And of course, the Canadians surrendered and said, okay, we're going to do some Canadian tacos for you. And hence, the problem that we got Friday, that's out of the picture. That's the good news when it comes to the trade front. The bad news, though, if you miss the orange tacos, you might get them pretty soon. Because Trump says that he's not going to extend the pause in the global tariffs beyond July 9th. And of course, we all know that once we get to July 9th, he's going to say, did I say July 9th? I mean July 9th, 2026. But this is really important because the month of July, traditionally speaking, is a pretty good month for the stock market. The only thing that could interfere with that right now is, of course, if we have Trump not making tacos anymore and says, yeah, we got the July 9th and now we're going to send the letters. This is what you're going to pay to do business with the U.S., as he says. Instead of 10%, you're paying now 30%. When you're ready to negotiate, call us. If that is the case, yeah, that could be a bearish catalyst for the market. And of course, the other one will be if there is a flare-up in the geopolitics, the flimsy ceasefire between Iran and Israel. But I think the most important catalyst that we have to look forward to is this tariff deadline. Now, the second headline is, over the weekend, we got the Senate passing the big beautiful bill, aka the big ugly bill. And now, of course, there is a debate because it has to pass the House again, since we had modifications on the bill, which, by the way, increased the deficit from 4 trillion to 5 trillion. So if you thought they're going to reduce the deficit, forget about it. Of course, we have 2 holdouts. We got Rand Paul and Senator Johnson from Wisconsin, but the rest of them all capitulated. All of that talk about fiscal conservatism. The moment the deal leader gets mad, okay, let me get on his side, otherwise he might primary me. And we saw the other senator from Carolina, of course, resigning, or retiring rather, because he opposed the bill. My 2 cents, if the bill passes the Senate officially, I think it's going to pass the House, but that's not good news. That's going to be pretty much the equivalent of suicide for the Republican Party, because once and for all, they have abandoned and crushed fiscal conservatism. And anybody who was voting Republican based on fiscal conservatism, that we have to get our house in order, you no longer have a home in the Republican Party. So they might please the dear leader in the short run, but they're going to destroy the party in the long run. Not to mention, of course, Bessent comes out, here's zero hedge for you. Bessent says this is the start of addressing the debt. Well, if the start is adding $5 trillion to the debt, what the hell are you talking about? This fool wants to be the next Fed chairman. Imagine that. $5 trillion added to the debt. Think about the consequences we're going to see in the bond market. Of course, Bessent right now is manipulating the bond market by issuing more in the short end of the yield curve versus the long end. He's doing the same playbook by Janet Yellen. But that's going to last until it doesn't. I think the passing of this bill will be a disaster in the bond market and beyond. Look at what's going on to the U.S. dollar already. The dollar is crashing. So everybody's saying, oh, the market is all-time highs. Yeah, but you're down over 10%, you fool. The value of your portfolio is down. And this is going to add more to the misery in the US dollar. And not to mention, of course, you're cutting Medicaid benefits. The majority of Medicaid recipients are Republicans. I mean, what the hell is this? What's going on here? To each his own, I would say. I just don't think it's going to end up pretty good for the party. The third headline of the day. Of course, we got Apple, a lot of jerky movements in the stock market today because the first headline that we got, re-Apple, is this one right here. It reads, Apple loses bid to dismiss U.S. smartphone monopoly case. Bad news, but the stock went higher either way. Why is that? Because shortly thereafter came the rescue, the plunger. And it's saying that Apple now is considering, thinking about using Anthropic or OpenAI to power Siri in a major reversal. And that's what the market was happy about, that we're going to go back to Apple using OpenAI. What's the big deal here? And isn't that an admission of failure? Isn't this Apple surrendering and waving the white flag in the AI war, saying that we can't do it? We tried. We spent a lot of billions of dollars. We couldn't do it. Siri is still dumb. And we got to use OpenAI or Anthropic. That all of the premium, all of the speculation of, Apple is going to be a leader in AI. They're going to sell products and have different platforms. All of that is down the drain, so this is not a piece of good news in my opinion. The only positive I could see here is maybe because Apple using OpenAI or Anthropic, which they have to pay for, by the way, so that's an additional cost. But maybe it's going to be less than the billions of dollars they're pouring in their own in-house AI with no tangible results at all. Maybe that's what the market is happy about. But of course, from a mechanical perspective, what you're looking at right now is the weekly calls for Apple. You can see high volume of the 202.5 calls all the way to the 210. And all of these call strikes have big numbers in the open interest and the open interest change. So I think the moment the news hit the wire, the market maker decided to hedge just in case, because the market maker, the algorithms might have read the news as positive, and they began to de-risk by buying Apple all the way to the highest volume of the day, which is 205. Now, if we continue to see volume showing up in the 210 and the 207.5, along with open interest change, that could also squeeze the stock higher in the next few days all the way to 210. But on the other hand, again, it's a piece of bad news, so we have to wait and see how the market is going to digest all of that. One thing I would caution you about is you might look at this news, and it is bearish. It is a negative for Apple because they're pretty much saying we failed in developing our own AI. And right now, we're just a hardware company again. We're just going to license some stuff from OpenAI, and that's it. So there goes your AI premium. At the same time, you could be right. At the end of the day, this could be a negative news for Apple, and they end up losing money and all of that. But you got to also understand the dynamics of the market. What am I talking about here? What you're looking at is the chart of the SPY minus Apple. If you take Apple out of the picture, the S&P 500 will be not just at all-time highs, but far above all-time highs. It'll be surging higher right now. In other words, what you're looking at here is an illustration that says that Apple has been a drag on the stock market. But here's the other chart I want you to pay attention to. This is the ratio of Apple versus the SPY. What does that mean, Maverick? It means that when the chart is heading down, the SPY is outperforming Apple. If the chart is heading higher, Apple is outperforming the SPY. And right now we've been heading down, meaning that Apple has been underperforming the market. What is interesting about this level, though? If we draw a line right here and then plug in the chart of Apple in blue, what we see is once we hit this kind of underperformance in terms of ratio, Apple versus the SPY, we see a rally in Apple. It becomes actually good news for Apple. Why is that the case? Because if I put my asset manager hat back on, it's the rotational element, especially now that we're at the end of the quarter. And what I'm talking about is the majority of the market rebound happened on the backs of NVIDIA and Microsoft. Well, those are overbloated right now. You can look at the chart of Microsoft or NVIDIA. All of them are overbought. So it makes sense as an asset manager to begin to book profits from Microsoft and NVIDIA, but you still want to be along the market because even if you have your own opinion about the economy or the market as an asset manager, you have to follow what the index is doing. So you're going to rotate Microsoft and NVIDIA gains toward the laggard. And the laggard is Apple. So you might see, despite all of this bad news, that we could see NVIDIA and Microsoft stalling, if not correcting down. But we see Apple rallying higher. And if that is the case, that keeps the indices afloat. So long as the losses in NVIDIA and Microsoft are not huge, Apple gains will make up for that. And this is how you keep the index afloat. You rotate out of NVIDIA to Apple, out of Apple to Microsoft, Microsoft back to NVIDIA, and that keeps the indices alive. Now again, I'm not saying this is going to be the case, folks, but I have to present all of the views that you need to consider, all of the possibilities that you have to consider. I think this piece of news is negative because it takes the AI premium out of Apple. Not to mention, of course, it's just a rumor right now. But at the same time, it could initiate that rotation back into Apple. And that could be a net positive. Now, in the charts analysis, I'm going to give you the specific levels that you have to look forward to confirm which case is playing out. Is it really we're seeing a rotation into Apple, or are we seeing just a bad piece of news that once digested, it's going to be reflected that way? So stick around for the charts analysis, but I think the biggest loser either way from all of this is Google, aka Alphabet, because whether Apple is going to develop their own Siri or they're going to use OpenAI or Anthropic, at the end of the day, that comes at the expense of Google. They're going to get rid of Chrome. And that means that it doesn't matter what Google does. They can invest in AI all they want. They can improve Gemini all they want. If they lose Apple users, they're going to lose millions and millions and millions of customers. So I think at the end of the day, the sure bet from all of this is that Google is the biggest loser. And I highly suggest that the company split into three. Not only that's going to avoid the regulation problems and all of the court battles that they have here in Europe, all over the place. You got to split the company into the Google Search AI, and maybe that's going to be the weakest segment if they lose Apple iPhones users. But the second one would be YouTube. It would be an individual stock. YouTube, again, the king of streaming right now. It's beating everybody when it comes to streaming. It's making major gains among the younger demographics, so that's highly bullish, but it's being masked by the weakness that we see from Google Search. And the third one should be Waymo. Waymo is unbelievably undervalued. If you look at the garbage Tesla, for example, Waymo is way, way, way undervalued right now, giving the market penetration that they already got. But all of that is being masked by the weakness that we see in Google Search/AI. We'll see if they're going to split or not. I think it is the best outcome that can happen for Google right now. Anyhow, a reminder, after this video, later in the evening, you're going to get an in-focus video for the members. We're going to talk about the weakness of the consumer. We talked about the affluent consumer in the previous video, but what about the actual regular consumer? What do we see based on the newest data? We're going to combine that, of course, by some of the retail stores' corporate earnings and the themes that we see, because you could see a lot of plays based on that analysis as the consumer downgrades from one retail store to another. So that's going to be the discussion in tonight's In Focus video. Join us, folks, if you can. Links in the description. But let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds in the green by 275.5 points, or a gain of 0.63%. The Nasdaq underperforming the Dow a little bit, 96.27 points to the upside, or a gain of 0.47%. It's also underperforming the S&P, which is not usually the case, but the S&P up by 31.88 points, or a gain of 0.52%. The leading indicator, the Russell 2000, positive, but it was the weakest among the bunch. Is it saying that we're going to have a pullback? Perhaps. But at least it's closing positive by 0.31 points, or a gain of 0.14%. It's not negative yet. Maybe that's going to happen in tomorrow's session. Looking at the sectors all in all, led by technology, and by technology we mean Apple. Look at the heat map in a minute. Financials, mostly the big banks. Healthcare showing some signs of life. The only laggards today, energy. Energy, of course, you got the ceasefire, Iran, Israel. Who knows how long that's going to last? But there's another dynamic we're going to discuss in the heat map analysis in energy. And of course, we have the OPEC meeting coming out really soon. So energy right now is under pressure, but you can nitpick certain winners within energy. I'm going to show you how in a minute in the heat map. But the laggard of the day is consumer cyclicals because of Tesla and Amazon. Both of them are down, and those are big enough to lead the entire sector down with them. Looking at the breadth, the market maker wins again. How do we know? If they close the day with a breadth, let's say closer to 50-50, they win, meaning that all of the calls and the puts that were bought the day prior end up expiring worthless, at least most of them. So in the NYSE, we have 55% advancing, 45% declining. The NASDAQ, we have 56% advancing, 42% declining. So it was, again, one of those days where the market maker won, and everybody who bought options on Friday's session lost if they bought the expiration data today. And this has been the dynamic of the market for a while now, week after week after week. The market maker keeps winning, and the only thing it can do is trade zero DTEs, open them and close them the same day. If you hold overnight, 9 times out of 10 you're going to lose money. You're going to see decay right away. This is at least the dynamics of the market right now. Let's do the heat map. And right off the gate, what stands out is the weakness, the underperformance that we see by the mega cap technology stocks. So NVIDIA flattish today, Microsoft, you see Google down, biggest casualty from the news that we got today. Meta, it's higher but stalling right now. I think it needs to correct a little bit. You got Amazon down about 2%, but Apple, see, that's what they do now. They give you a little bit of weakness in Amazon and NVIDIA, perhaps Microsoft, and then they rotate to Apple. It pushes 1.5% a day. And all along, it keeps the indices alive. So you really need to see all of them stalling here. And then the rest of the market doesn't matter. You can see the rest of the market trading in the green. If you have NVIDIA, Microsoft, Apple heading down, that's enough to push the tape down. My 2 cents. I think absent of a trade flare-up that we could see in this month, the assumption should be that the month of July should be positive. But I think we'll see rotation out of chips, the outperformers, let's say, in the last couple of weeks. And we're probably going to rotate back to software. So you see software, there are a lot of good names here that could be catching a bid, like ServiceNow, like Shopify, Autodesk. Trade Desk today up about 4%. So you could see that rotation within technology from the chips that are overbloated, overbought right now, back into software, back into cybersecurity. Of course, the exception is Palantir, that's quasi-defense contractors, and then you have Oracle, that's an AI play. So I would avoid the ETFs since software ETFs are heavy in Oracle and Microsoft, and I'd rather bet on the individual names within software. As far as financials, we see the banks rebounding, Visa, MasterCard. I think those were sold for no good reason, really, because of the stable coins. So we sold some put debit spreads, or credit spreads rather, on Visa, MasterCard, and I think that's the play right now. They're going to correct a little bit, but of course it is a threat. The stable coins a threat, but the drops that we've seen in these two names, not justified because of that reason alone. A little bit of weakness that we see here in the regional banks, among them, of course, Douche Bank. I don't know why it is regional, but it is a German bank, so it shouldn't be really regional. It's huge. But anyways, D-Bank is not doing pretty good here, down about 3.5%. And I think if we look at the chart, maybe we're seeing a top showing up in Douche Bank. I would speculate on it via options. And a reminder, if you zoom out in this chart, Douche Bank hasn't recovered the crash during the financial crisis. So this is what happens when you have bubbles. You rally like crazy. And the last bubble was a banking bubble / housing bubble. Once you crash, it takes years or decades to come back. So that's something to keep in mind, the AI bubble that we have right now. Back to the heat map, I see some firming up in the big pharma, but I would not chase it, to be honest with you, right here until we get more clarity about what's going to happen with the big pharma tariffs. We have to see what they look like before. There's a chance they could be sell the rumor or buy the news, but you got to see it before you follow it. Some names are firming up here, looking pretty good. Abbott Laboratories, we own that in the portfolio. Medtronic. So these names are okay to begin to speculate on in healthcare, but the big pharma, got to hold your horses until we see what the tariffs are going to look like. Industrials moving up for the most part. There's nothing, an outlier here besides Boeing down a little bit. It's a little bit overbought in the hourly, so it's pulling back a bit, but I don't think that it is a big deal here for industrials. Utilities, you have NextEra down. That's your clean energy play because of the big beautiful bill, or ugly bill, I would say. Not pretty good for green energy, so we see NextEra down, but Duke is up, Southern Energy is up, National Grid. So these are the plays that I do like in utilities. Gold miners back on track, baby. Look at this. Huge gains in metals leading the pack. You have also the fertilizers coming back up again. Mosaic up about a little over 3.25%. So I would stick to being in the long side for these guys. A little bit of a pullback for the copper miners. But if the dollar continues to go down, they're going to recover and move higher again. Big gains for FCX last week. So some profit taking right here. As far as energy, we see the big ones going down. Exxon, and I will actually agree with that. Exxon, Shell, Chevron. And the reason is there was a rumor that maybe Shell is buying BP. What that kind of initiated in the energy market, and we talked about this last week, that we're going to see a lot of M&A. And the assumption is, of course, the big guys will be buying the smaller guys. So when the big guys buy smaller guys, what happens? The stock goes down, but it benefits the smaller guy that is getting bought. And this is why I said we're going to concentrate a little bit here in these midstream plays, specifically Kinder Morgan. And I gave you the chart, gave you my thesis why I think Kinder Morgan is bullish, and now it's up about 1.5% today. LNG is heating up too, so I do like these two plays right here. KMI, Kinder Morgan, and LNG. I also do like the refiners, like Valero to a certain extent, so I think if we see a green move tomorrow, that's going to be support, and it's probably going to be the support that you want to buy. These guys, the big guys, that's going to require, you have to see crude oil going higher, but you have the OPEC meeting coming out really soon. So you don't want to really bet on crude oil or the big guys until we get the OPEC meeting out of the way. The concentration should be right around here in the midstream plays. We see the defensives, the dividend-paying names finding a footing. I mean, GIS was a disaster last week. Now it's finding a footing. Here's what I would say. Smucker, same thing, crashed. Now it's up a little bit. What is with the bullishness that we see today in the defensives? There are a lot of chatter right now. The Federal Reserve will do a premature rate cut. If they do that, the data says that the dividend-paying names, specifically in the staples, begin to lead the market again. So if you're betting on a premature rate cut by the Fed, be the pressure by Trump against Powell or whatever, then you probably want to pick up some of the dips that you've seen in these dividend-paying names because historically they do outperform if we have a premature rate cut by the Fed. Not so hot so in the consumer side, so the EVs not doing pretty good because of the big ugly bill, but you have my boy Revvion is up about 1%, so we're going to stick to Revvion here, but Tesla, lots of challenges, GM down about 1%, but I think with the Canadian deal now, the tariffs are out of the way. I think that GM probably going to find a footing sooner than later. But then you look at other consumer names, Amazon down. You see here the apparel still down, home improvement down. The affluent consumer and the cruises doing okay, but again, you don't see the hotels, for example, doing pretty good. They're kind of muted. The casinos kind of muted. So we have that inherent weakness in the consumer besides the affluent in the cruises. And then we have the defensive plays here. O'Reilly, AutoZone, the auto parts, those are pretty good. The dips have to be bought in these names. Shark Ninja, look at this, up about 2.5%. So I think we're going to hit that 100 before we find some resistance. Carvana, that's a retail name, a squeeze kind of option kind of plays. So it doesn't really reflect anything about the auto or the used cars picture in the economy because you see the others like CarMax, like AutoNation doing something different than Carvana. Looking at the telecoms, pretty good for the defensive telecoms like Verizon, AT&T. Still good for the risk-on plays like Netflix, Spotify down a little bit, but Netflix, Disney still doing okay. I would still suggest that if we see a premature rate cut or the odds for that begin to increase, you probably want to be here in the Verizon, AT&T side, not so much in the Netflix, Disney side, because you want to be in the dividend-paying side. Moving on to commodities, we see crude oil down a tick, WTI, Brent also down a tick. Of course, the OPEC meeting will be really, really important. We know that we're going to have supply increase, so everybody knows that the supply is going to go higher. Now, is it going to be as expected, below expectations, or above? If it is below expectations, we're probably going to see a rally in oil, despite the production increase by OPEC. So keep that in mind. RBOB not moving a lot. Heating oil was the gainer today, about 1.5%. And nat gas, the biggest loser, down about 8%. But nat gas is really, really volatile. It could be down 8% today, then up 6% tomorrow. But right now, I would say that fertilizers plays like Mosaic and Nutrin are much, much better than natural gas plays. Looking at the softs, we see soft action in both coffee and sugar, which is a relief for the consumer. At least we can drink some coffee and have it sweet. But you have cocoa going higher, so that's not good news. Cocoa about 0.5 percentage point higher, but other than that, pretty muted action in softs. Looking at metals, of course, the dollar is down, so metals love that. You see support coming in for gold. You see platinum going higher a tick. A little bit of a pullback in copper. Palladium down 3%, but again, palladium has got tracked platinum. So I think that the dips in palladium are to be bought so long as the dollar is going down. Yet the best hedge against the dollar besides gold would be a foreign currency. Now you see the Japanese yen up today, you see the Canadian dollar up, you see the Swissy up, the CHF. The Australian dollar is up about 1%, the euro is up about 0.75%. So you got to understand one thing here first. If you own the stock market and the dollar goes down, it doesn't matter if your stocks are going higher. You're losing value. If you have your money in the bank right now, you've lost about 10% of the value. You continue to lose so long as we lose value in the dollar. So you got to have some exposure to alternative dollar assets, which I've been talking about numerous times in this program throughout the year. And I gave you a lot of plays to do it. Besides gold, the currencies, the metals, you have a lot of plays. You got to pick one of them, the one that you like, and stick with it so you can hedge against the decay in your US dollar assets. Now, grains close early today and Monday, so we have to look at here, soybeans. This is the real close. It's not what you see in the grid. You see soybeans down a tick, but wheat and corn beginning to move higher, just under 1% worth of gains. Now, wheat and corn are going to track oil futures. If we see oil going higher, you're going to see wheat and corn also moving higher and vice versa. Moving on to the options market activities, what do we see here in the big casino? I'm looking, of course, for suppressed IV ranks and changes in the PC volume. What is that going to give me? That's going to give me good entries for specific trades. So for now, NVIDIA, when you look at the IV rank at 7%, what does that say? It's still cheap. It was 0% just a couple of days ago. And had you bought calls at that point, you made a big score because just the increase from 0 to 6 or 7% is going to move the value of these premiums higher, even though you might not see huge gains in the stock itself, but you're going to see an increase in the volatility premium for these options. Now, when we have a suppressed IV rank like 7%, you look at the PC volume put to call volume, increasing above 50%, that's the leading indicator that you have a pullback coming in the name. You're probably better served buying puts this time around in NVIDIA. You see that appreciation of implied volatility versus calls. I think the opportunity for the calls was behind us. Now the opportunity is for the puts. Look at the different case here that we see in Apple. You got the IV rank at about 26%, so it's still cheap, but you have the PC volume at 29, meaning we see more buying of calls versus puts. So if I'm just reading this data verbatim, the mechanics, my 2 cents would be long Apple, short NVIDIA. The other one that stands out is SoFi to a certain extent because you have the IV rank is still kind of low by 34, 35, but the PC volume is increasing, now at 48, about to cross 50. And we're going to look at the chart in a minute. But that tells me that the pop that we've seen today is an opportunity for you to book some profits, sell some covered calls, and maybe begin to suggest that we have a pullback coming. So you want to hedge a little bit. The other one that stands out for me is Tesla. Tesla, the IV rank is about 25%, so still cheap. All of the options really cheap. With the VIX down below 20, all of the options right now are cheap. But in the case of Tesla, the put to call volume is about 88. You can read that in two ways. The first way is to say that we're seeing more demand for puts and that PC volume can move all the way to 90, even to 1 and beyond. And that suggests that we have a flush coming in Tesla. You could look at that as a second way, since the PC volume is 88, which is pretty high, that maybe we are getting to peak bearishness in Tesla. And you might get the number Wednesday, the sales number. It comes out bad, but it is better than expectations, better than feared, they say. And you see a rebound in Tesla. How do you know which one is going to play out? I think tomorrow's session is going to be really important in Tesla. If you see a rebound before the number, then that put to call volume is going to decrease and allow Tesla the room to go down once the report's out Wednesday. If no, we see Tesla down again tomorrow, 2-3%. And the PC volume will be really, really elevated. And at that point, you get the report coming out Wednesday, and you might see the opposite reaction. So tomorrow's session is going to be really, really important for Tesla. Let's move on to the unusual activities, beginning with the bullish ones for GLD. Every time you see a pullback in gold, somebody's buying big. In this case, somebody bought the 315 calls. Stock right now trading about 304. They sold the 335 calls as a debit spread for the expiration date of August 15th. In other words, they think that GLD will be above 315 by August, but not above 335, so they're using that leg as a financing mechanism. All in all, spending about $14 million. Got another one for you here for RDDT, Reddit. Somebody bought the 160 calls and they sold the 190. So it's a similar structure as the GLD. It's a debit spread. The expiration date a little shorter, though. It's July 18th. The stock right now trading about 150. They're betting on 160 and beyond, but not above 190 by the expiration date. All in all, spending about $1.5 million. How about Palantir? The volatility went down a little bit versus, let's say, a few days ago. Somebody's taken advantage of that by buying some calls for the expiration date of July 11th. The stock right now trading about 137, but they bought the 144 calls, the 152.5 calls. And they spent about $2 million on those. Here's another bullish one for you for the EWZ. This is the Brazilian ETF. It also works as an anti-dollar or let's say inverse dollar, not anti, but inverse would be the appropriate term here. Inverse dollar kind of play because it is heavy in commodities. And right now the stock's trading at about 29. They're betting on 30 and beyond by August, so they bought the 30 calls. All in all, spending about $4 million. Now, when I look at the chart of the EWZ, the weekly chart, is there a possibility that we could move higher? Yes, there is a possibility we could move higher. So it's worth speculating on, but it is still not the best looking chart, to be honest with you. It's been consolidating for years. On the positive side, though, it pays a dividend over 5%. So if maybe it's going to be a dividend play plus a bet against the dollar, I think it's worth exploring. But right now, as I said before, maybe the Korean market is a lot better, the European market to a certain extent. So right now, we're going to stick with that. Maybe at some point, I need to see a little bit more before I'm convinced that EWZ is a buy at this point. I like it, but I'm going to be patient. How about the bearish trades? We begin with SoFi. The data suggests that maybe we're getting toppy here. So somebody bought the 16 puts for different expiration dates, August 1st and the 15th. The stock right now trading at about 18.5. They spent about $2.5 million on those puts. Now, we look at the chart of SoFi, weekly chart. We have a gap above the weekly upper Bollinger Bands. The risk versus reward would say that you want to book your profits, sell some covered calls, buy some puts, aka collar strategy to lock in some of your gains. Now, a lot of you watching this program are SoFi shareholders, and we got a lot of questions about it today in Discord. And my suggestion was you got to sell some covered calls, maybe finance some puts, buy some puts. Just in case it goes down, you have a protection strategy, insurance policy, and you're not paying much for it. Then we got GE. Somebody bought the 250 puts. The expiration date is September 19th. The stock right now trading about 257-ish. They spent about a little over $1.25 million. GE is really tough to short. Every time you think it's going to go down, it just pops right back up. So we'll see if they're right or wrong, but this one is really interesting for me. It's an SPY diagonal put spread. What does that mean? It means that they bought, the main bet is the buy leg, which is the 575 puts. The expiration date is Jan 16, 2026. In other words, the SPY trading at about 618 right now. They think that the SPY by Jan 26 will be below 575. But it's not going to be below 550 before the sell leg that they've done, which is October 31st. So they sold that leg to finance the long leg, which is the 575 puts. All in all, spending about $89 million. Huge. And we've seen this trade, by the way, last week too, over $100 million. So somebody here is betting that despite all of this optimism, that we're going to head down. And they're using that diagonal structure to play it. I think that it is a smart way to play it. And that leads us to the next one here in the Qs. These are long puts. We don't have a spread structure here. It's just naked puts, and they bought two of them, though. They bought the 515. The expiration date is Jan 16, 26. I think it's the same trader who did the diagonal in this SPY. Then they sold the 480 puts. The expiration date November 21st, 2025. We're trading right now about 515 the Qs. So the bet here is that we're going to see the Qs below 515 by Jan 2026, but not below 480 comes the expiration date of November 21st. All in all, spending about a little over $18 million. I've talked about this pattern numerous times before, that when we have sort of a rising wedge and we get a false breakdown, you usually see a false breakout, and then you settle down back within the wedge. And you'll see that the breakout or the breakdown, which one of them was the real one, which one is faking them. I think we have to reconsider the dynamics for the month of July. And that would be, of course, the month of July is mostly positive. We haven't had a negative July for years now. Even within the bear market in 22, July was pretty good. On the other hand, you have the deadlines and the trade agreements. If there is, for example, the president coming out saying, here's the tariff rate that you have to pay, and it's higher than the 10%, that's going to be problematic, and that's going to lead to a breakdown in the market. But right now, my 2 cents would say that we push down a little bit here just to correct within the wedge, maybe a retest to 6,100. And if there is no flare-up in the trade war, you're probably going to see the market floating its way higher again. And the reason for that pullback could be also technical in nature, because you have the RSI getting a little overheated here, and usually you don't see it trading above these levels for too long. Usually there is a pullback that happens. You've seen it here in 24. Last time we got a reading like this. You've seen it here in 23 when we got a pullback too. So the anticipation is we're probably going to pull back a little bit here in the E-mini futures. 6,100 would be my target. And if we lose that, then we have to assess what's going on in the dynamics of July. Is it really a trade war flare-up, or is it just a technical pullback? If it is just a technical pullback, it's probably a dip you want to buy. If it is a trade flare-up, you probably want to short it, hedge it. And then we segue to the IWM, the small caps, your leading indicator. Why are we skipping the Qs? It doesn't really matter. The Qs is going to follow the S&P 500. Both of them are tech ETFs right now. They move based on NVIDIA and Apple and Microsoft. So if you do one, you don't have to do the other. But the IWM is unique in its small cap components and the fact that it is considered as a leading indicator. The good news for the IWM is we do have a close technically above the 200 days moving average. We'll see if we're going to close above that by the end of the week or not. If we do close above the 200 days moving average by the end of the week, and by the way, you can actually use the 50 weeks. So cancel the 200 right here, plug in the 50 weeks rather. And this is the one I'm going to look at because the 50 weeks is more reliable than the 200 days moving average. So if we close above the 50 weeks moving average here in blue, I think that's going to seal the deal that the IWM is saying, wait a minute here, we have a bullish phase coming in all markets and it's probably going to be led by the IWM. And of course, the IWM has a inverse hidden shoulder pattern. If we plug in the 200 again for the daily, that's what really matters. So it could lead to a breakout where we see 225, 230. But if we close below by the end of the week, below the 200 days and below the 50 weeks moving average, then we have to examine again. What is the reason behind the weakness? Is it just a technical pullback? Because if you plug in, for example, the momentum indicators, be it the MACD, be it the RSI, it could be not overbought right here in the IWM, but it is overbought in the SPY and the Qs. And if those pull back, they're probably going to drag down the IWM with them. So if that is the case and we see a break below the 200 days and the 50 weeks moving average, then it's not really the most bearish thing to happen. But if we see the IWM closing below the 200 days moving average in the 50 weeks because of a trade flare-up, that's going to be a problem. That's going to be a leading indicator to say, watch out. We're probably going to head back to bearish dynamics. Maybe the market now got a refill and the president is going to feel more emboldened to be tougher in the trade war. So again, context really matter in the month of July. Are we just pulling back because of technical reasons, or are we pulling back because of trade reasons? The next important chart is the dollar, and the dollar been flushing down in the toilet, pretty much lost a lot of value year to date. It is overshorted though. So a lot of folks are now saying, what if the dollar, for example, catch a short covering rally? Well, in that case, you probably want to hedge your gold position. But for now, the indicators say that maybe we're going to have support if we switch to the monthly chart here. Maybe you'll see that trend line of support right here, and we might catch some support from it. But on the other hand, you look at the weekly chart, and we still got room to become even more oversold. And honestly, I just don't see good dynamics for the dollar with the passing of the big ugly bill. That's going to add more to the debt and the deficit. That's bad for the dollar, and there's a lot of pressure for the Fed to do a premature rate cut. All of that is adding to weaknesses in the dollar in bonds. Not seeing so much bonds right now. It's mostly concentrated in the dollar. And the reason is you got your boy Scott Bessent, of course, issuing more bonds in the shorter end of the yield curve, not the longer. So he's doing the same manipulation by Janet Yellen. That's going to last for a little bit. But if this is not resolved, if the dollar continues to go down and we continue to see addition to the deficit, that's going to be problematic for bonds too. Looking at gold futures, if we see the dollar heading down more, then the assumption would be that gold futures probably forming a higher low pattern, and it's going to move higher again. Now, there is a possibility we could see, for whatever reason, maybe the Federal Reserve, Jerome Powell, will be hawkish all of a sudden and say, no rate cuts. You guys are pricing in 3, I'm going to do 1, or no rate cuts at all. If we see, for example, any inflation data showing up, that could lead to a short covering rally in the dollar and leads gold to go down. But right now, we lost the 50, and that's probably what supports the bearish argument against gold futures. If we close above the 50 again, then that argument is out of the window. The other thing you want to consider is the Bollinger Bands. So we got a little bit oversold here. So we have an oversold rebound in the daily chart of gold futures. I'll feel more comfortable, to be honest with you, if we close above the 50 days. That's going to say, okay, it was just a false breakdown and back on track we are in gold. And that's going to happen, of course, only if the dollar continues to weaken. What does that do to the GDX, the gold miners? We have 2 supports. We have the 50 days. We caught a nice support out of it. We closed the gap here in today's session. Big gainer GDX today. We also have the gap support. So it's a double support here for the GDX. Of course, it's going to depend on gold futures. It's not going to be able to rally without gold futures heading higher. but you see that the gains in the GDX are oversized on a mere tick higher on gold futures, which tells me right here that gold miners are really, really undervalued. And folks are just using any excuse for gold futures to move higher to double down on their bets on GDX. I'm still bullish GDX. I think we're going to head higher, but there is a little bit of risk that if we could see a short covering rally in the dollar for whatever reason, that we might head down in gold. So what is the approach here? I'm going to stay long GLD. I'm going to stay long GDX, but I'm going to buy some puts if I see a loss of the 50 days moving average in the GDX. I'll be buying the 50 puts just as a hedge against my really big GLD position that I got. Another benefactor of the dollar flushing down is copper. Copper right now playing the cup and handle pattern. Let's mark that right here, cup and handle. And then after that, we have probably consolidation of a bull flag pattern. So right now, gold or copper, any of the inverse dollar assets are saying that no, dollar is going to head down, we're heading higher. But like I said, as traders, as investors, you always have to have that hedging in the back of your head. What if we see a reason that could lead to the dollar to pop or see a short covering rally? In that case, I think that you have to hedge if we use the GDX or we use any copper play. But right now, the main thesis is bullish gold, bullish copper. It looks to me like a bull flag here, and it might want to retest the highs before it begins to stop. It's a little overbought, but it's not really the most overbought reading that we've seen here on the RSI. I think it could have another pop higher once it passes 70. I think that's going to be a good point for hedging, booking profits, that kind of thing. And here it is, the talk of the day, Apple 2 hours chart. What do we do here? You got Mama Bear at 200. So if we lose 200, that's going to turn Apple bearish on the 2 hours, the daily chart. It will probably going to go down to 196.50. But right now we have this inverse and shoulder pattern. Today kind of played out. We have resistance at 203. We've beaten that. So that's kind of solidifies a little bit, just a tilt toward the bullish argument for Apple. The next stop would be I'm going to place the bull right here at 207.5 because this has been a reliable resistance before. And if you manage to close above, okay, now Apple is bullish and you have to go long Apple. You have no other choice but to do that. For the reasons that we talked about rotational asset managers, when they begin to rotate from NVIDIA, Microsoft to Apple, that's going to be a tailwind for Apple. But like I said, the news that we got today is not necessarily bullish. It could be digested and then the traders, investors will decide that, hey, this is actually bearish for Apple. And if we go down again below 203, then it's just a one-day wonder. And we're probably going to break 200 and head down negative. So keep that in mind. 207.5, really important number. 203, close below, the bearish argument is still alive. You close above 207.5, nope, it's going to be bullish, not bearish. Why? Because we have to switch to the weekly chart of Apple. And right now it is sandwiched between the 200 weeks moving average and the 50. 200 in orange, of course, the 50 in blue. The most important to me is you see what's going on in the MACD right here. We could see a reversal in the momentum from bearish to bullish. And 207.5 will be my indicator. If we close above, okay, we have a bullish move toward in the weekly MACD, maybe a corrective stance. Maybe it's not going to pass zero, but it's just correcting a little bit of the losses that we've seen recently in Apple. That could lead Apple to retest the 50 weeks moving average at about 222.5. So that could be a possibility if we close above 207.5. And I would trade it accordingly, of course. If I see a close above 207.5, I'm probably going to go with the 210, 220 call debit spreads. If we see, on the other hand, Apple losing 203 in tomorrow's session or by the end of the week, they'll probably want to double down or add to the 200, 190, or 195 put debit spreads. NVIDIA, anything to see here? Maybe it is kind of beginning to get a little bit overexhausted. As you can see, the RSI is kind of way overbought. So we anticipate that NVIDIA is either going to stall or pull back, and that could be a positive for Apple if we see a rotation. But right now, there is some pressure on the 160 calls. As I see the options market data, we could hit 160 before we begin to stall. I would say that if we lose 153, then there is a shot of correction all the way to 145 because there is overextension here outside of the 50 and the 200 days moving average, but mostly the 50. You're not going to see divergence like this without at least stopping to allow the 50 to catch up or coming back down to meet that 50 at some point. So right now, I would say that I would look for 160 if there's a failure at 160 or before. My assumption would be 153 as support. If we lose that, then we're probably going to head down to 145. There's a gap right here. The highs at about 148. That could be another soft support before we hit the hard support of 145. The souffle Tesla 2 hours chart. What do we see here? Not looking pretty good. Of course, there is a bullish argument that maybe we have sort of a falling wedge. We break to the upside. The sales number coming out Wednesday, maybe better than expectations. Got it. But there's the other case, which is how about a topping head and shoulder with your neckline at 313. You lose that, you got to flush down in Tesla, and of course, the numbers could be a catalyst coming out Wednesday. But the other catalyst, of course, is the big ugly bill, which pretty much takes out the EV credit, and that's a negative for Tesla. That's why Elon Musk is pissed off about this bill. But right now, I would say the odds would lead to topping in his shoulder. If you see a pop, for example, before the number comes out, that's going to be bearish for Tesla, and I'll tell you why exactly, because it's going to be the shorts who shorted maybe right here, or right here, or right here, booking their profits and doing some short covering before the number comes out. If that is the case, then the falling wedge already played out, and the likelihood is the number is going to be disappointing and we head down after that. So that would be the dynamic I'll be watching for. But of course, losing 313.30 is really, really bearish for Tesla. If you're bullish Tesla, you don't want to lose that support, because if you do, you're going to head down to 300 really fast. And after that, you're probably going to cut all the way down to 290s, one step at a time, of course. Anything to see here on BTC? For now, we have a pattern of lower highs. You could argue that this is maybe a bearish engulfing candle that we're seeing right here. But hold your horses. I would not really short Bitcoin here until we lose the 50 at least. Better yet, the 104,000 support, because there is a case that it could consolidate and break its way higher. Now, would you go long Bitcoin right now, this level right here? No, only if we break above 110. If we close above 110, then I'm interested in going long Bitcoin, because we're probably going to see a surge higher based on the momentum that we see right here in the MACD. But there is a possibility we could roll over. So once again, 110, break above, close above, we'll be buyers of Bitcoin. If we break 104,000, instead we'll be short Bitcoin. The last one I want to show you here is Caterpillar. I mentioned that in my morning brief today. We see sort of resistance here showing up in this line, sloping line of resistance right here. And it is a little bit overbought if we expand the RSI. A little bit overbought, so I anticipate a pullback, a stall in Caterpillar. And that might give me a chance to sell some call credit spreads at the 400 level, or maybe 390, or we'll do that probably in tomorrow's session, and raise some cash from Caterpillar, because it is a stock trading closer to 400, so you can raise a bunch of credit from this one right here. On the weekly chart, though, it is above the 50 weeks moving average, and I think it's going to break above that resistance at some point and reach the all-time highs right here at about 418.5. So in the weekly, it remains bullish. It's not going to turn bearish unless you lose the 50 weeks moving average right here. But on the daily, I see an opportunity that we could raise some cash using that elevated RSI by selling call credit spreads. Keep that in mind. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We got the big zombie, Jay Powell. We'll see what he has to say, because everybody right now is saying, oh, Jay's going to capitulate, he's going to tackle, and he's going to cut rates. Right now, the market is pricing in 3 rate cuts. I think without weaker economic data, forget about it, but the market right now is betting on it, so we'll see what he's going to say, whether he's going to increase the odds for rate cuts or decrease them. That could have a market effect. Then we have the manufacturing PMI. All eyes on, of course, the price index. We got construction spending on top of job openings. But with that, folks, let's wrap it up right here. Thank you for joining us tonight. But this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. We'll meet some of you again tonight, but the rest of you will talk to you again tomorrow. Good night.